Good afternoon, everyone, and thank you for joining us on Jindal Stainless Limited's Q1FY21 earnings conference call. We have with us Mr. Abhyuday Jindal, Managing Director, Mr. Anurag Mantri, Chief Financial Officer, and Mr. Gautam Chakraborty, Head Investor Relations of the company. We will begin the call with brief opening remarks from the management, following which we'll have the forum open for an interactive question and answer session. Before we start, I would like to point out that some statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the results presentation that was shared with you earlier. I would now like to invite Mr. Abhyuday Jindal to make his opening remarks.
Thank you. Good afternoon, everyone. On behalf of the management team of Jindal Stainless Limited, I welcome you all to this forum. And I sincerely hope you and your loved ones are safe and healthy in these unprecedented times, especially since now a second wave seems to be coming. So even more important that we are again keeping extremely safe. I would like to first share the key financial highlights of the period, following which Anurag will take you through the operational and financial highlights of the quarter ended 30th June 2020. Entering the new fiscal year, it was full of uncertainty, with the spread of COVID-19 and as a result, extension of lockdown with various restrictions had put all economic activities under unparalleled challenges. We also got badly impacted and our plant operations had to be suspended from 25th March until 4th May. This shutdown, along with supply chain issues, primarily impacted our performance during the quarter. However, we believe that more than ever, this extraordinary situation has highlighted the operational strengths of the company. JSL has demonstrated agility to ensure continued operations and seamless transition to newer ways of functioning in the face of multiple challenges. For instance, in the face of constraints and muted sentiments in the domestic markets, the company was able to successfully target export markets. Additionally, JSL's ability to seamlessly switch series-wise production levels to match the ongoing market demand also contributed towards better average utilizations during Q1 of this year. I am pleased to state that the demand and operational-led challenges that had emerged now have been abated. We are already witnessing an improvement in the domestic demand scenario and are therefore expect business reverting to normalcy by the end of September 2020. Uptick in the healthcare and two-wheeler segments, along with likely improvement in retail segment during the festive season, is expected to boost the demand for stainless steel. Additionally, the demand from conventional sectors like construction, transportation, process industries are also seeing traction gradually. As far as the trade scenario is concerned, the Indian stainless steel industry continues to face challenges due to the increasing import from FTA nations, especially Indonesia. Having said this, I would also like to welcome DGTR's recommendation to impose CVD on stainless steel flat products from Indonesia to safeguard domestic manufacturers from subsidized imports. The Ministry of Finance will take the final decision regarding the same, which is still awaited. As an industry leader, JSL remains well placed to benefit as Indian manufactured goods gains traction under the government's vocal for local call. Looking ahead, we believe that our strong manufacturing excellence, nationwide distribution network, coupled with a unique set of capabilities and comprehensive offerings, will enable us to navigate the multiple uncertainties ahead of us. JSL's business fundamentals remain intact to address the inevitable rebound expected in the overall stainless steel industry. With this, I would now like to hand over to Anurag, who will take us through the operational and financial highlights of the quarter ended 30th June 2020. Thank you.
Thank you, Abhyuday. Good afternoon and warm welcome to everyone joining us on the call today. I will briefly take you through the company's operating and financial performance for the quarter ended 30th June 2020. As discussed by Abhyuday, the macro level challenges primarily impacted the Q1FY21 performance of the company. On a quarter-on-quarter basis, our sales volume declined to 88,814 metric tons, primarily due to widespread disruption in supply chains and suspension of manufacturing activities. The plant operated at average run rate of 33% during Q1 FY21. Similarly, EBITDA for the quarter was also impacted due to the COVID-19 induced business environment, and it was at rupees 78 crore. The interest cost for the quarter was at rupees 131 crore, registering a year-on-year decline of 8%. During the quarter, the company availed moratorium benefit of rupees 44 crore on interest and rupees 61 crore on repayment from its lender as per the RBI guideline, which has helped us to maintain our cash flow in quarter one. We expect debt reduction of rupees 350 to 400 crore during FY21 after considering this moratorium. Over the years, the company has been taking multiple initiatives to sustainably improve its balance sheet. As a testimony to this, recently CARE has upgraded and Fitch has reaffirmed JSL's credit rating to BBB with a stable outlook. This emphasized JSL's comfortable debt and improved financial position after the CDR exit. Furthermore, this development also reflects a resilient business strategy despite interruptions caused due to the pandemic over the last few months. It underscores the consistently improving performance in the asset turnover, healthy operating profit, and reduced debt level, which validates the strengthened balance sheet profile of JSL. Company's board recently approved the fundraising of 162.8 crore by issuance of warrants convertible into equity shares of the company to promoters and Kotak Special Situation Fund, subject to requisite approvals. The pricing of the issue has been derived as per the SEBI guidelines, and 33% of the issue's proceeds will be payable upfront, and the balance will within the SEBI prescribed timeline. The proceeds of the issue will augment cash flow and be utilized for strengthening the long-term working capital. Upon conversion of conversion of these warrants, the promoter stake will increase by 1.75% from 68.11% to 69.86%. We believe this is a very positive development, and the equity infusion by the promoters reaffirms the confidence in the long-term prospects of the company. To conclude, with a strengthened balance sheet position, JSL was able to navigate a truly challenging period for the global economy. With the demand outlook for stainless steel witnessing an uptake across industries, and as a dominant player in the industry, we are well positioned to capitalize this opportunity going forward. This brings me to the end of my address. I would now expect moderator to open the line for the Q&A session.
Sure. Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Anyone who wishes to ask a question at this time, they may please press star and 1. The first question is from the line of Amit Dixit from Edelweiss. Please go ahead.
Yeah, hi. Thanks a lot for taking my questions, and congratulations for a stable performance in a very challenging quarter. So I have 3 questions. The first one is on volumes. Given that volumes were quite impacted in Q1, what kind of volume we are looking at in FY21?
Okay. So maybe FY21, Amit, overall basis, we are expecting around not more than 15% dip in a full year basis. So we expect to regain the volume in next 3 quarters. Obviously, the quarter 1 was badly hit, but still we will regain some of these lost momentum. And overall basis, we still expect the year to close not more than 15% lesser than the last year volume.
Okay, thanks. The second question is on overseas subsidiaries. So this quarter we reported an EBITDA level loss of 136 million. I mean, if I subtract consolidated and standalone, that's how I have got the number. So the EBITDA level loss is at 136 million compared to profit of 582 million in the previous quarter. So as I understand, these subsidiaries are quite stable in nature, but what resulted in such a drastic shift, and how do you see things going ahead?
Right, Amit. So basically, what has hit in Indonesia also similar thing which we faced in India earlier, and being a smaller plant, similar Chinese competition really hit bad for the Indonesia market also. So that actually took some of the beating on this subsidiary our subsidiary based out of Indonesia. But few business measures which we have taken in last 3 to 6 months to completely change our business strategy in Indonesia. So one is that now instead of 300 series, which is more competitive in terms of the Chinese and some of the local Chinese manufacturing within Indonesia, we started now more focusing on 200 series in Indonesia. Second, overall, we have restructured that entity and reduced our employee cost 60% and administration cost by 38%. Basically to realign the complete business model, so we are even break-even profitable at even the lower volumes. So this plant has a larger capacity, but even when we don't see a volumes pick up, we can be profitable in those scenarios. So second is then entirely align our overall cost structure within that entity. Third, we started focusing on the fewer of the niche product, especially for Europe and US market for export purpose. So which should also give us the good results. So overall, we expect this now entity to now have a more cash break-even situation in next few months. In terms of other subsidiary, Iber, it was more an exception last quarter, I would say, because the early close down in some of the Europe and Spain has resulted a large inventories level in Iber. But this loss is more temporary because then they have to dilute some of the inventories at lower prices. But we believe that this is a more temporary phenomena, and Jindal will again come back into the same profitability zone.
Okay. The third question is essentially on the series split. So what was the split of series, the split between 200, 300, 400 in Q1FY21? And what do you see it in FY21 overall?
So Q1, the series mix was actually more tilted towards 300 because largely since the market demand at that point of time was 300. So again, this talks about our ability to quickly shift the series mix in our portfolio. Because in Q1, the large demand was actually of 300 series. So 64% was 300 series, 400 series was 17%, and 200 series was 19%. However, on full year basis, we still, as last time Abhyuday mentioned, our strategy was to actually continue to focus on 400 series. And now we are seeing the auto demand coming back again into that, which consumes largely the 400 series. Overall basis, we still believe that for 400 series we will be able to gain approximate 25% and 300 series should be around 50%. So Q1 was more an exception, I would say, in a mix.
Okay, great. Thank you so much and all the best.
Thanks, Amit.
Thanks, Amit.
Thank you. The next question is from the line of Chetan Shah from Abacus Asset Management. Please go ahead.
Yeah, hi. Just one quick question. A bit of a clarification. When you mentioned about the series mix of 300, 400 and 200, which is 50, 25, 25, that means you are saying that the remaining 9 months we'll be able to do better in 400 series than we'll do in 300 series. Is that a right understanding?
No, that will not. Basically, the percentage of 400 will rise from what we saw in the previous 3-4 months. But 300 series will still be the highest quantity that we sell.
Understood. And sir, in terms of understanding the balance sheet profile, what you think will be our end of the year debt will look like? And if you can give us some color on what's the debt repayment schedule we have for next 3 years.
Yeah. So, Chetan, in terms of overall debt repayment in this year, we still expect, even after taking the moratorium, of debt reduction of around 350 to 400 crore on a full year basis. So earlier, our targeted debt repayment, if you recall, in the last call, we mentioned around 550 crore. It may not be 550 crore, but still we are targeting to reduce by 350 to 400 crore basis in this financial year. Now, from next financial year, the scheduled debt repayment is around next year is in FY22 will be around 300 crore, and FY22-23 will be around 290 crore.
Okay.
So close to 300 crore in next 2 years, I would say, on an average, next FY22 and FY23 will.
Okay. Thank you so much. Thank you.
Thank you. A reminder to our participants, if you wish to ask a question, please press star and 1 at this time. The next question is from the line of Vishal Chandak from Emkay Global. Please go ahead.
Hi. Thank you for taking my question. So, given the fact that from FY21 to 23, we are targeting close to about a reduction of about 1,000 crores, and this would obviously improve our balance sheet position very comfortably. So the natural follow-up would be on what are the capex plans now, and how do we look at expanding our capacity at Jajpur facility?
So good, thank you for your question. Still whatever decision we are definitely looking at if we need to expand depending on what the demand supply conditions are. But whatever we do will be completely from a sound financial planning. We are not going to go for any major big bang expansion if we don't see the growth coming from the market. So I would still say it's a little too early to comment on what our capex plans are. We are still working on them. Hopefully by our next investor call, we will have better information for you. But as of now, because of the pandemic and we are still evaluating how the export market vis-a-vis the domestic market will perform, and that is in the works right now. So I'm expecting by next investor call we can have a better answer for you.
Sure, sir. So that I would presume would be from a growth capex perspective. But on a sustenance capex, what should it look like, sir?
So sustenance capex, Vishal, typically remains in the range of around 150 crore maintenance and sustenance capex, and it's going to be the same for us even in the next 2 years.
Right. So my next question was with respect to the probable restructuring at the group level. When we talk about this question we have received over from several investors as well. How do you allocate the business between JSL, JSHL, and what are the plans on long-term merger, if at all? Are there any thought process on that part?
Okay, so again, these things are still, if I say, being worked out at the management level, because we have just exited CDR now, and what our plans are in terms of capex, in terms of merger, this is all jointly we are currently discussing. So it's definitely something that we are working towards, we're thinking towards that. When will we do it? Does it make financial sense? Does it make sense for all our shareholders, stakeholders? So that is what we are currently discussing right now. And again, next few months we should have a little more clarity.
Yeah. By end of this calendar year, we will come back with the best option available for us which is in the best interest of all the shareholders. So we are, as you rightly said, I think we are actively evaluating the various options which is in the best interest of the shareholder, and by end of this calendar year we will come back with the plan.
Sure. Thank you, sir.
Thank you.
Thank you. The next question is from the line of Ashish Patel from India SME Investments. Please go ahead.
Hello. First of all, congratulations on good set of numbers. Despite challenging time, we were able to be EBITDA level positive, and we also managed to repay 83 crores on this quarter. So, first of all, my question is regarding the anti-dumping duty, the final findings which DGTR gave. So, post that announcement, are you seeing some price improvement in terms of our product realization or reducing competition, something on those lines?
So just to clarify, this is actually what DGTR has currently recommended is CVD on flat road products from Indonesia. Anti-dumping investigation is separate and that is on, which will take a little longer. But DGTR has recommended, even right now, just to make clear, Finance Ministry still has to confirm that. So until that does not happen, duty is not levied. Secondly, CVD, because what will happen is actually the domestic players will come to a level playing field against these imports from Indonesia. But it will not really be able to improve our prices as such because the stainless steel industry is still completely governed by raw material prices. And if import from Indonesia, for example, does reduce because of the CVD, India still has FTAs with many other countries, Japan, Korea, Malaysia, Vietnam. So then, if it reduces in Indonesia, what ends up happening is that it can pick up from these other countries. So in terms of a price increase, it is again too early to say, but I really feel it will not have a direct impact on our price, but more that it will be at a level playing field with imports coming from Indonesia at least.
So when you say, sir, level playing field, can we get a sense that we can attain double-digit margins like we did in FY17 and FY18?
Because again, I'm saying, because if Indonesia imports reduces, but then imports increase from Japan and Korea, so again, we will have to look at the demand-supply conditions, we will have to look at the raw material prices, and then only we can do pricing. Just with this duty coming in, will we be able to take a price increase? That is not going to happen.
So what would be the number one trigger, sir, if you want to attain double-digit margins again?
So double-digit margin, as we mentioned, that we will regain the lost volume. So we are still expecting to achieve the because double-digit margin will be able to sustain because at least irrational imports will not be there, as I mentioned. So that surely with our target not going to with that our target is not to remain in the single-digit EBITDA margin. So at least double-digit EBITDA margin is surely on the cards.
Sure. And my last question would be that as we see from past 3 years, we have been able to generate average cash flow of 1,300 crores, whereas our repayments are only 300 crore per annum going forward. There are no bullet repayments as well as such. So financially, we are at very sound position. Now, do you think it is a good time to give some thought on dividend payment or related to on those lines? Because shareholders in our both of our company have not made any decent money in past, say, more than 5 years.
Yeah, no, I think so. What we will do, you are right now, as going forward, as the cash flow starts accruing, I think we will what will be the best value creator for shareholders now onward because obviously last almost 10 years we were struggling under the CDR and into the deep losses. So which has now the balance sheet is now in a very sound position. And it will always be a balancing between then how gradually, depending on how the cash accrual coming, and what kind of few of the, because then in Odisha we have a very multiple capex opportunities in a smaller parts also, which could actually give a much larger booster in terms of the overall shareholder value. So like if you to give you the example with just 40 crore of investment, we actually increased our capacity by 35% last year. So 0.8 to 1.1. So obviously we'll have to balance between what can, and those could be a larger value creator for the shareholders overall perspective. But yes, you are right. I think we'll have to balance with what kind of value creation opportunity we see in terms of the some of the extended expansions as well as the dividend payment, and we'll take a call accordingly.
Sure. So sir, my only limited point is that promoters are already showing very good positive indications to the market by infusing, say, 150 crores. So if they declare dividend, the market would take it very positively that after a gap of, say, more than 1-2 decades, we are declaring dividends. So that would be considered as very positive sentiment for market.
Yes, sure. We take note of your suggestion, and yes, we will take whatever decision in the best interest of shareholders.
Sure, sir. Thank you so much. That's all from my side.
Thank you.
Thank you. Any participants who wish to ask a question at this time, they may please press star and 1. The next question is from the line of Bhavin Chheda from Enam Holdings. Please go ahead.
Yeah, good afternoon, sir. Can you update what the current utilization levels would be in the July, August, September, how the utilizations have been shaping up?
Okay, so in terms of capacity utilization, July we were, I would say, at about 75%. August we were at 85%. And September, we are almost at 100%. I will say between 95 to 100%.
This is based on 1.1 million of SMS, right?
Correct.
So September, you are saying you are already at 100%.
Yeah, we are almost at 100%. I won't say absolutely 100%, but almost 95 plus.
Fine. So when the things normalize, they are almost normalized. So probably in FY22, you can probably deliver close to 10 to 11 lakh tons of volumes. I think your historic high volumes, I believe, was 9 lakh 73. So probably you can cross that number in FY22.
Yes, definitely.
Yeah. So on our operational side, we don't have any bottlenecks to reach close to 95 to 100% capacity of roughly around 10.5 to 11 lakh tons of volumes.
Not at all.
After that, you will probably try to debottleneck that 11 lakh number into a new number, right?
Correct. That we're still working on. Like I mentioned, we're still working on our future expansion plans and capex plans. But in terms of at least delivering 1.1, we have no bottlenecks.
Right. Now, in terms of cost-saving initiatives, I'm sure you would have tried to reduce some fixed cost here and there, and also on the operational side in the pandemic period. So if you can guide what were the steps taken by you in last 3 to 6 months, and what part of cost savings would be permanent in number, and what can come back?
So a few of the measures, Bhavin, and which will have a long-term impact. So one was this ICD, our internal container depots is now operational. So which will give us a close to almost per container basis almost 4,500 rupees. So overall, if we put it in a number, basically 2,200 container movements happen. And this, in an overall term, it will have almost 11 crore annual impact because of the saving in terms of the EBITDA. But the larger saving in terms of through this way is that will be reducing our detention demurages risk as well as improving the working capital. So which will have a consequential much larger strategic impact of this. Similarly, as if you recall, Vidya mentioned in terms of last call, the multiple sourcing initiatives which we have taken. So shifting to the near shore, asking our large stockyards to open and set up the facilities next to our plant to reduce our commodity exposure as well as the transit time. So all these will be a more long-term, which directly cannot be a quantifiable impact that way, but yes, it will surely have a much larger long-term implications on the EBITDA side. OPEX side is a continuous process in terms of the various right from power and fuel to strategizing our employee cost in terms of the overall people deployed in the production processes. So those are actually an ongoing process, I would say. So which will, and this pandemic has given us a few of that, as Abhyuday narrated in his opening remarks, the new ways of working and manufacturing also, which include manufacturing also. So which we have taken certain steps into that, and we believe that in a long term, but obviously we are increasing the production, so we can say that within the same people cost, we can actually deliver the larger volume.
Sure. And what would be the current domestic and export volume mix be like?
So if I say during the lockdown period and the pandemic, I mean, where first quarter, it was almost, I would say, 60% domestic, 40% export. And now it will again switch back to our original levels of 80%, 85% domestic and 15 to 20% export.
So on a higher capacity utilization, almost 80% is getting sold out in domestic market.
Domestic market, correct.
Right. And you mentioned of 200, close to 200 crores of debt repayment in FY21, and after that 300 crores per annum for 22 and 23. That would be correct, right?
No. So, Bhavin, what I mentioned is that long-term, short-term put together, overall, we are still targeting debt reduction of 350 to 400 crore in this year.
Okay, in this year you're targeting 350 for them. Okay.
And after that, next two financial year, FY22, FY23 will be around 300 crore.
300. Okay. So this year will be higher because you are anyway raising 160 also, right? But this would be in warrant, so money would come, 75% would come over 18 months, right?
No, so 33% will be coming in October. So
Okay.
it's minimum requirement, you are right, is 25%, but it's been decided that the 33% of the money will be, one-third money will be put up front.
Okay.
And the balance will be within a year's time, as per within that stipulated time it will come.
Sure. Okay. Thank you. Yeah.
Thanks.
Thank you. The next question is from the line of Ritika Gupta from Equitas Investments. Please go ahead.
Hello. Hi. I wanted to know the realizations have trended upwards in Q1 of FY21. How do we see them for the remaining part of the year?
See, Ritika, in stainless steel, the realization is largely driven by the mix and the underlying raw material prices.
Right.
Now in Q1, the raw material prices were stable, but as we mentioned, the mix was highly tilted towards 300 series, which is the costliest series.
Right.
Costliest in the sense, in terms of realization, which is the largest realization series. Therefore, you see a very high realization in Q1. But overall, as we mentioned, it was more aberration, and we switched to 300 series because the market, when the lockdown started opening up, initial demand was for that particular series.
Right.
But now we are seeing railways and auto started picking up, so again 400 series will start gaining momentum, and so it's actually realization doesn't give too much of insight in terms of the EBITDA, because the two extreme series, the average realization is between 400 and 300 is almost 1.5 to 2 times. But that similar is not the case in the EBITDA margins.
Okay, so can you tell us EBITDA margins for each of the series then?
See, so best way to look at is that overall EBITDA, what we are targeting, and despite if you see in this quarter, our EBITDA per ton was badly hit. It was just 8,737.
Right. That was under absorption, right?
Right. So, but still, despite this quarter, we still expect to maintain our guidance of 12,500 to 14,500 average EBITDA per ton during FY21. So we still, because what kind of momentum we are seeing and the volume, a higher volume which will deliver, we still maintain our guidance of 12,500 to 14,500 for a full year basis, despite being a challenging quarter one.
Okay, and I really thought that we were impacted in the last few quarters. I've seen all Abhyuday's statements in the press release regarding being impacted by the imports from Indonesia. So why is the CVD not going to impact us financially, as in like in our profit and loss statement?
See, because again, it is the same thing, because again, Indonesia is definitely the biggest importer.
Correct.
But what these companies and these Chinese organizations are very quick to react, they can start circumventing and routing it through our other FTA countries. So like I mentioned already, there are investigations already on for ADD and other CVDs from other countries as well. Indonesia, if you see over the course of last 3 years,
right,
from only about maybe 5% import into India, it went up to 60-65%.
Correct.
So that is why that volume impact would definitely reduce. Will we be able to directly impact our bottom line? That is still very early to say, because exactly same thing happened. You see, China got some CVD on it, they started routing through Indonesia. Now Indonesia gets some CVD, they can again start routing it through these other countries. So which is why I am still little cautious, and I still feel that it's still too early to say, because these are generally what we've seen happening in the market.
But I understand that the government is also planning to do country of origin, right?
So, Ritika, you are right. There are good things, there are good steps which includes the country of origin, anti-circumvention laws which are becoming more restricted with the newer provision. So therefore, if you still see, I think surely this type of thing should remove the non-level playing field. So our challenge was actually we are not threatened by the imports. We were always threatened by it in terms of the subsidized imports, not to have a level playing field. So what Abhyuday is saying, we'll have to still cautiously watch. But having said that, I think therefore we are still not changing our guidance on a full year basis, despite the bad quarter one. Otherwise, if you see on an average, we would not be able to deliver just 12,500 to 14,500 EBITDA per ton, which we are still continue to maintain our guidance.
Okay.
So this is on the back of we expect at least irrational imports should come down, but obviously we'll have to really watch very closely, because people are always smart to find other ways.
Okay, how have imports been in Q2?
Q2 imports, I think we still need to date the data. I think it's still early to say Q2 imports.
Okay.
Yeah, it's been fluctuating. July was less and August picked up again. September, obviously we are in September, so I can't comment, but it is fluctuating.
Right now this CVD has not been come into force, just to clarify, because Ministry of Finance still has to approve it. So right now there is no CVD as
currently.
Yes. Okay, so we've done quite a good job in our operational efficiency, but how do we improve our interest costs? And where do we see them in FY22?
Yes, so in terms of overall, one is that repayment which we continue to maintain. So as I mentioned that 350 to 400 crore repayment will be there in this year, and next year 300-400 crore. Now, since our rating has started moving up in terms of the performance, and as we continue to deliver better performance, our rating should further improve. So we are targeting the more move towards the A category of rating, where we can start actually getting the good rate benefit. But having said that, at least this year on overall portfolio, we are expecting 0.5% still dip on overall portfolio basis, because mind you, the large part of this loan, 800 crore, we raised it actually in just early March this year. Okay, so we may not get a rate benefit immediately on those, because those were actually part of the CDR exit strategy, and those were taken accordingly. So we may not get on that, but still I am saying one is that volume impact we will get on term loan, and second, at least 0.5% on an interest cost basis, we will get a reduction in next year. On the second bigger component is actually of our interest cost is the working capital.
Yeah.
Which obviously will be always a function of the volumes also. But as we keep moving, we are taking multiple measures to reduce our working capital cost also.
Right. So in absolute terms, what is our what interest cost outgo do we expect in FY21 and 22? It was around 500 crores, if I'm not 515 crores in FY20, if I'm not mistaken.
FY20 interest outflow was Just let me see. I think it was 570.65. 567 was FY20 outflow.
Yeah. Okay.
FY21, we expect, because some of the loans moratorium which we have taken, so which have a certain increase in the interest cost, because the moratorium loans will also get added for the interest. I'm assuming the interest on interest, not banking on any of the Supreme Court decision. So the total interest cost in this year is expected to be around 540 crore in the P&L. However, the cash outflow will be only 466 crore, because 74 crore will be booked in P&L, but the cash outflow will not be there due to the moratorium.
Okay, and like going forward for the next few years, because I understand like till we don't improve our interest costs, like our profitability improvement is going to be marginal.
Yes, so next year, as I told you, that we will get a benefit of the repayments as well as the 0.5% reduction on the term loan. On working capital side, I think we will continue because since we are improving the volume also, so we may not, our working capital cost will not increase, but the same working capital cost will deliver the larger volume.
Okay. Okay, thank you.
Thank you.
Thanks, Ritika.
Thank you. A reminder to participants, if you wish to ask a question, please press star and 1. Next question is a follow-up question from the line of Amit Dixit from Edelweiss. Please go ahead.
Hi. Thanks for taking my question again. I have just one question. Can you let us know the cash flow from operations in this quarter and whether there was any working capital release as well?
No, sorry, Amit, I haven't got your question. Cash flow from operation and the second
in this quarter, and whether there was any working capital release as well in this quarter, Q1.
Yes, Q1, if you see on overall basis, there was basically, if I say, the PBT was 138 crore and the 44 crore was the interest moratorium. So overall, excluding exception item, there were 95 crore of the PBT. With this, the depreciation and tax, if I add, so overall, there was almost 47 crore impact, but which was actually being met up by the after moratorium, which has been met up by the increased working capital utilization.
No, so what was the cash flow from operations in this quarter?
So it was the negative of 47 crore.
Okay. Fair enough. Okay. Thank you. That's it.
Thank you. The next question is a follow-up question from the line of Ashok Patel from India SME Investments. Please go ahead.
Sir, I just wanted to know that in terms of production, cost of production, how well are Chinese placed with compared to us? So do we have the same cost of production and they are just able to export it at subsidized rate just because of the government incentives which they are receiving, or they really have lower cost of production compared to us?
It's actually very, very difficult to answer both questions because information coming out of China is never ever, absolutely clear. So it is whatever information we get from our own sources and a little bit from the government sources. But in terms of, if I tell you, then subsidies are definitely provided. They have cheaper power, they have cheaper logistic costs, their funding rates are much, much cheaper. So in terms of other than our operating costs, they have definitely subsidies in all other areas. In operating costs, I can still say we can be comparable to Chinese, even though they might be getting some raw material benefit in terms of now, if I give you an example, India has duty on imported raw material which is not there in the country. We have taken this up with the government multiple times. Like there is duty on ferronickel, there is duty on scrap, MS scrap, whereas China has export duty on these items. So that is the kind of difference that is there between our country and the countries we are competing with. So in terms of operational cost, I feel because of our efficiencies and the kind of work we continuously do, we are comparable. But because of the subsidies, because of the additional infrastructure benefit, banking, financial benefit they get, we are not able to compete on that.
Sure, sir. And you mentioned 50 bits lower interest rates from next year. So that would be applicable to the entire long-term loan?
It will be applicable to almost 60% of the loan portfolio, because 35% are the new loans which we have taken.
Okay.
So it will be applicable to 60% of the loan portfolio.
60% of the loans including short-term loans, right?
Yes.
Sure. That's all from my side.
Thank you. The next question is from the line of Saket Kapoor from Kapoor & Company. Please go ahead.
Good evening, sir, and thank you for the opportunity. Sir, of late ferrochrome prices have been on an upward trajectory. So, for what was our last quarter average purchase price, and what are the prices ruling currently, and how is this going to affect the match in translation at the finished product?
Yeah, hi. Am I audible?
Yes, Gautam da, please.
Yeah. So in Q1, the ferrochrome prices averaged at around 63,875. Prices were actually falling, and there was a lack of demand from Chinese market, and that is the reason why prices were falling earlier. But after that, there was some stability in the prices that we have observed now, and there was some kind of increase in the overall prices. In fact, for Indian market, if you look at, India is actually a net exporter of ferrochrome, and in couple of months back, there was no export demand, so the prices were depressed in the domestic market. But after that, there was some improvement of late.
What are the current prices ruling, sir? Any
Around 73,000 per ton.
Okay. So for this quarter, sir, our blended cost will be in that vicinity only, upward of 70,000, and that will have an impact on the margins.
So basically,
we increase our prices accordingly with the increase in ferrochrome. We have to move with the raw material prices. So we will move with the movement of ferrochrome that is happening, and I don't think so. The prices are expected to stay so strong. It should come down to the range of 68, 69, I believe.
Okay. So because the other story is on the South African mines being closed, and there's a vacuum for the production side, and the scarcity there in the market, and only two.
That's why it has gone up so drastically. If you see, otherwise last year, completely last year, it was around 60,000. And because of the news from South Africa and also India, that has led to the increase, such a drastic increase in prices.
Okay.
So Saket, in this context, because we are also fully captive in terms of ferrochrome, we use ferrochrome in liquid form also. So we don't purchase ferrochrome as such from the market. So that way, to a large extent, we are protected.
I didn't get the point, sir. How are we?
So I'm saying that ferrochrome is we have a captive facility of 250,000 tons of ferrochrome in that food.
Okay. So we are purchasing chrome ore and then processing the same.
Yes, correct.
Okay, sir. And then the chrome ore prices would be also linked, sir. In that case, so how will that be mitigated? Just to dwell on the same. Chrome ore, we don't have our own mines, so when we are purchasing from spot market, the chrome ore prices have also moved up.
So yeah, that market volatility always is there, but it is already to a large extent is mitigated because of our in-house production, and also since we use ferrochrome in liquid form, we save a lot of energy costs in that process.
Okay. And lastly, sir, on the graphite front, also electrode front, can you give some idea of the price trajectory? How have the graphite electrode prices behaved for last quarter and now with the quarter which is ruling, September quarter?
Yeah, so graphite electrode prices also have been falling,
Compared to, let's say on a year-on-year basis, we have seen almost 60% reduction in graphite electrode prices for this quarter. And however, there are we can't take a call exactly what will happen and all in terms of the graphite electrode prices as such. But we see more or less stability probably in in this kind of level, because if you look at on a year-on-year basis, the reduction will look very significant. But on a quarter-on-quarter basis, still about 9 to 10% kind of reduction that we have seen.
From June to September also the prices have reduced by 10%? This is what you were trying to say?
This is more or less stable almost on a quarter-on-quarter basis as of now.
From June to September also, post June quarter also, July and September prices have remained stable for graphite electrodes.
More or less stable.
Correct, sir. And sir, lastly on the utilization levels, sir, I missed the earlier commentary. So what kind of utilization levels are we about to close for this quarter, sir? Expected line?
Utilization should be above 95%. Oh, for the quarter will be, for this month I was talking, sorry, for quarter will be around 85%, you can say, 80 to 85%.
So sir, gradually we are reaching the pre-COVID level faster. I mean, by
Correct.
this month itself 95 agar aata hai, so it is a commendable job, sir.
Yes, we
now
are
we
seeing
are
a
on-
V-shaped recovery.
Okay. Now we are only waiting for the duty part to come to play, sir. That would be.
No, duty is not something that we work towards, and that is not something that it's a very short-term thing. So we are continuously focusing on developing the market, reducing the costs, focusing on better efficiency. Duty comes, doesn't come, is separate from what our daily activities are.
Okay. Now, so you were talking about level playing field as earlier you were explaining. So that would be added to the margins only if it happens. So
again, not really to the margins, but it will definitely impact in planning better, I would say.
Right, sir. And sir, congratulations to the promoter for infusing further capital with the, I think so, EGM is scheduled in a day or two. So a good step taken for not taking loan and infusing equity at these prices. So it's a good step, and it gives the right direction to minority shareholders, sir.
Thank you so much.
Congratulations to you, sir. Thank you, sir. Thank you, sir. I'm done.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for their closing comments. Thank you, and over to you.
Thank you everyone for attending this call and for showing interest in Jindal Stainless Limited. JSL remains positive that its strong positioning in the stainless steel industry and improving macros would help it to deliver steady and consistent growth going forward. With this, I hope we have been able to answer all your questions satisfactorily. Should you need any further clarifications or would like to know more about the company, please feel free to contact our investor relations team or Citygate. Thank you once again for taking time to join us on this call. And also, just one thing to add, our new website we will also be launching by the end of this month, beginning of October. So further communication we will also be sending, but I just wanted to inform everyone from my side as well. Thank you.
Thank you very much.
Thank you.
Thank you, ladies and gentlemen, on behalf of